Episode 5 of Season 2 of SAP Concepts. The finale. Controlling. The management lens, where every transaction finance gathered gets sliced by dimension. Four lenses on controlling. Cost centers and profit centers, internal orders, product costing, and COPA with the Universal Journal. And the one row that finally fuses finance and controlling, ACDOCA, the centerpiece of SAP S/4. Controlling's job is to make the financial reality navigable. 5 questions. In priority order. Where did this cost go? Which department, team, or facility incurred it? The answer lives on the cost center. Whose P&L does it land on? Which segment of the business owns the result? Lives on the profit center. Was this for a project, an event, or a one-off? That gets a separate collector, an internal order. And what did each unit cost? Sliced by what dimension? Product costing and COPA answer those. A cost center is a place in the organization where cost is incurred and accumulated. A department, a team, a facility, the IT help desk, the welding line, the marketing team, the procurement office. Every cost center has a manager, a validity range, and a profit center assignment. That's how cost flows from controlling to a P&L. Cost centers are organized into standard hierarchies that mirror the org chart. Welding rolls up to manufacturing, which rolls up to the company. When finance books a posting, the posting carries a cost center assignment. Controlling captures the same value against that cost center. If cost centers are about where cost lives, profit centers are about whose P&L it lands on. A profit center represents a segment of the business held accountable for a result, a product line, a brand, a region. Both revenue and cost land on the same profit center, and a P&L can be drawn for it. In ECC, profit center accounting was a separate ledger, reconciled overnight, rarely matched. In SAP S/4, profit center is a column on the Universal Journal, same source of truth as finance. The reconciliation problem disappeared. A cost center is for steady-state activity. The IT help desk runs forever. The welding line runs forever. But not all activity is steady-state. Some of it is project-shaped, event-shaped, or one-off. That's what an internal order is for, a temporary cost collector with its own number, validity, and settlement rule. When the work is done, the order's cost is settled, pushed onto a cost center, an asset, a project, or a product. Then the order closes. Trade show booth, R&D project, office renovation, equipment repair. All classic internal order use cases. When production planning creates a production order, the planned cost was components at standard plus operations at the activity rate. Where did the standard come from? Product costing's job. Take the BOM. Look up each component's standard, recursively if it's also manufactured. Add the routing operations priced at the workcenter activity rate. Add overhead via costing sheet rules. The output is a standard cost estimate. Once released, that number becomes the material's official standard. Every variance flows from it. COPA, Profitability Analysis, the most used controlling output in any company. Take every revenue and cost transaction, slice by characteristics: customer, product, region, sales channel. A typical query: gross margin on product line A in Northern Europe for direct customers in Q3. The system reads the Universal Journal, filters to rows tagged with that combination, returns the answer in seconds. In SAP S/4, account-based COPA is the default. Always reconciles to finance, because every characteristic lives as a column on ACDOCA. ACDOCA, the Universal Journal, the architectural payoff of SAP S/4. In ECC, finance and controlling were separate ledgers, reconciled overnight. The reconciliation rarely matched. In SAP S/4, finance and controlling became one table. Every row carries the finance fields and the controlling fields together. Account, debit, currency, document, period, cost center, profit center, internal order, region, channel. One row. Every finance, controlling, group, COPA, and profit center report reads from this same table. It's not a Fiori thing, it's not a HANA Speed thing, it's a data model thing, and controlling is where you feel it most. The Fiori app for cost center work is Cost Center Performance. Filter by hierarchy, period, currency. Click a center. See planned versus actual variance percentages, drill down to finance documents. Replaces ECC's KS01, KS02, KS03, KSB1 chain. The other tile is profitability analysis. Pick characteristics, pick value fields, pick a period range. Slice ACDOCA. Both apps read the same Universal Journal rows. Finance and controlling are no longer two ledgers in conversation. Two views on one ledger. 6 pieces of controlling sitting at the edge of intro and advanced. COOM allocations, assessment and distribution cycles that move overhead by driver rules. Activity-based costing, group reporting and consolidation, material ledger detail. Legacy profit center accounting and predictive accounting in SAP S/4. The COPA configurator and the costing accountant are senior roles at most shops. That's the depth path. Season 2 recap. 5 modules. Finance is the books of record. Materials management is buying. Sales and distribution is selling. Production planning is making. Controlling is the management lens. Together, they form the operational triangle, the financial backbone, and the analytical layer that gives all of it meaning. And ACDOCA is what makes the one data model coherence possible. The deepest answer to why SAP moved to SAP S/4 to fuse finance and controlling into the same row. Everything else is downstream of that. That's Season 2. 5 modules, the full SAP S/4 mental model. Thank you for watching. Subscribe for whatever Season 3 brings. Until then.